So Larry Gaines helps individuals generate greater income from their investment capital with less risk exposure. He founded PowerCycleTrading.com and the Power Cycle Virtual Trading Room following over 30 years of professional trading experience in the commodity and equity market. During his tenure as head of the international trading company that often traded $1 billion worth of commodities in a single day, he learned firsthand the necessary elements of a successful trading system and the use of options. Using this in-depth knowledge and experience, Gaines developed the power cycle trading model to allow for greater profits with a more disciplined, systematic degree of trading success. Today, he'll be showing us a 5-step plan for options income success. Larry, it's all yours.
Thank you very much, Kevin, and thank you everyone for being here today. So let's get started. First off, the following webinar is purely for educational purposes only, and any stocks, options, futures mentioned does not constitute advice or should not be construed as a recommendation. Yeah, I've been trading for over 30 years, and just a little bit more background. I was the executive vice president for one of the largest oil trading companies in the world and ran their international trading desk out of Bermuda for over 10 years. We were one of the first groups to trade over-the-counter options on crude oil and trade millions of barrels of these options. Went on to launch the over-the-counter option brokerage desk for the largest privately owned oil brokerage company in the world, PVM Oil, and that was a great experience. Did a lot of brokering of over-the-counter options with hedge funds and institutions and banks. So a lot of background in trading, a lot of background in options, and options are kind of my passion. I really enjoy the stimulation that they give from just the creative ways that you can use options. So what I'd like to do, I like to kind of get a feel for everybody that's at the webinar here, and how many of you would like to be more active in the markets trading, maybe as a full-time job, but you just don't feel like you're quite ready or not confident enough yet to go for it. Just put in a yes or no. Just kind of like to get a feel for the people that are in here. Seeing lots of yeses. So yeah. So just a little background. I can still vividly remember when I went out on my own trading, actually full time for my own money. It was at first a very nervous type of start for me, and I was having it be your own money on the line. It was a totally different feeling. When it was your hard-earned dollar, it did not have that same type of feel. When it was somebody else's money. When I was running the international trading desk, I found myself in plenty of nerve-wracking trading situations. But at the end of the day, it really didn't affect me personally. As long as I followed the owner of the company's, trading protocols and rules we had in place, he was okay with, trading losses. It's part of the business. And believe me, we had some really ugly losses at times. And it's never any fun to lose. But you know what? It wasn't my money at risk, my savings. It was the guy I was running the desk for, and he was extremely wealthy. So it was a really different type of uncomfortable feeling when I took a loss with my own trading capital. And then the other thing too was that there was a difference with when I started trading my own account and my trading style. When running a large trading desk, our trading style was very aggressive. We had a lot of capital behind us at our disposal, so we would really kind of trade from a big momentum type trader standpoint, and we were able to push the markets and use that to our trading advantage. But when I began trading my own account, I found myself trading much like I was still trading money, for a big hedge fund, which I was not. And my trading drawdowns, somebody says they can't hear it. Can everybody hear me okay? I believe so. Yeah, I think it might be just from your end. Sorry. So what happened was, my trading drawdowns were not good, and it was very stressful and painful. So I had to really change my trading style if I wanted to be successful and succeed in the business. So now the trading from my own account really improved though once I learned how to better control risk And the other huge breakthrough was learning how and committing to limiting downside in any trade taken. And I did this using option spreads. And then the real big aha trading moment for me came when I started taking advantage of option premium collection type strategies in my trading. So once I committed to this, it became a totally different game, and I could really kind of sleep at night. And I really believe that probably 60 to 80% of a trader's success comes from how you emotionally handle, how you emotionally handle the markets. And it can really come down to just keep it in check, your big emotions that surface from fear and greed. But what I've found is that when you know the maximum loss you can incur based on your trading setup and you're okay with it, then these fears are relieved. And the really cool thing too is that option strategies allow you to completely control your risk, by using spreads. You decide, ahead how much risk you're going to have, and then you structure the trade accordingly. And it's really that simple. And that's why I'm really excited about option income strategies, and then what I'll be discussing here today with you guys. So let's get started. And if you don't mind, hold your questions as much as you can till the end, and then I'll cover the material first and get into all your questions towards the end of this presentation. So ask yourself this: what if you could add a new stream of income now? Would it change your life? And if the answer is yes, then do you have a plan to achieve that goal? So what I'm going to show you today is a 5-step plan I put together, and the first step is how to embrace risk for trading opportunities, and then avoiding the #1 option trading mistake, most important option factor, how option pricing works, and then the highest probability option strategies for every market. So first, though, the first step is how to embrace risk for trading opportunities. And I tell my clients and my members to embrace risk. Don't fear it. Look for the opportunities that risk present you. And trading is all about managing uncertainty. The fear of uncertainty can really kill your account if you shift your approach of choosing to manage risk instead of uncertainty. Then you'll create an account winner. So the question is then, how is this done? First off, you need to put together some kind of trading plan. It can be very simple. It doesn't have to be too complex. But some of the things that you need to have within that plan is to choose your risk limits, own accountability for your trading decisions, understand the risk with the strategies you choose to use, know how to defend any trades you enter within your chosen risk parameters, and choose trades that have defined risks that meet your guidelines, because you're in charge. So you need to have all of these things in place. So the main thing is you are in charge. Step 2, avoiding the big #1 option trading mistake. And this is so important for anybody starting out in options, and it's also a good lesson for anybody that's still trading options, to kind of review what you're currently doing. Option trading has many more advantages than trading stocks, but it is a little bit more complicated. And for somebody that's new at options, it can be a little intimidating too. That's why many investors will decide to begin trading options by buying short-term calls, especially those out-of-the-money calls. That's where the strike price is above the current stock price. Since they seem to follow the same pattern, most people follow this pattern of let's buy low and sell high. It's been kind of ingrained in us from all the brokerage commercials you see on TV and hear on the radios. So this is an example to illustrate this point. So imagine you're bullish on Facebook and it's trading at $65. As a beginning option trader, you might be tempted to buy calls 30 days from expiration with the strike price at around $80. And those particular calls would cost you 15 cents or $15 per option contract. Now, why are you tempted to do this? Well, when you look at it, you can buy a lot of them. So let's do the math. And remember, one option contract is equivalent to about 100 shares, or is equivalent to 100 shares of stock. So if you set out and you purchase 100 shares of Facebook, that's $65. That would cost you $6,500. But you could take that same $6,500 and you could buy 433 contracts of those 80 calls, and that would control you over 43,000 shares. Man, when you do the math on that and see it, it's like, wow, that is big, you know, holy smokes. So then you think, okay, well, imagine what if Facebook hits $81 within 30 days, and the $80 calls that you'd bought at $1.05, which is equivalent to, well, which is $105 per option contract, just prior to option expiration, it's at that level, 105. Well, when you add up that money, you can make $38,970 in a month. So, you know, you're thinking, man, at first glance, this kind of leverage is just awesome, you know, but don't let the glitter fool you. One problem with short-term, out-of-the-money calls is that you not only have to be right about the direction the stock moves, but you also have to be right about the timing. Now, this really ratchets up that degree of difficulty. You know, to make a profit, the stock doesn't just need to go past that strike price, but it also, you know, must do this within a defined period of time. So in the case of this $80 calls on Facebook, you need the stock to reach $80 within 30 days to make your profit. Now, you know, in this example, you're asking that stock to move more than 23% in less than a month. And, you know, on this this example, that would be like a 2 standard deviation move. And it really comes down to, you know, how many stocks, you know, really are likely to do that. Well, you know, we'll see things that can do that. We'll see Tesla and that Triple D. Some of these things will go explosive, but not. But the normal standard is no. You know, they're not going to move 23% like that in a month. So not many. So in all probability, you know, the stock would just not reach that strike price, and the option would expire worthless. So based on probabilities, and then trading, you know, trading is based on probabilities. And in options, we can use standard deviations. There's only about a 5% chance for this stock reaching $80 by expiration. So in order to make money on an out-of-the-money call, you either need to outwit the market or get plain lucky. So there's an old saying, you know, when I was on the trading desk and we were having a bad day, we'd say, you know, there's remember that blues song, and in that the lyrics were like, if I had no bad luck, I'd have no luck at all. So, you know, there's not a whole lot of luck sometimes in trading, so it's best to know your plan and stick to it. So being close means no cigar. So you imagine that stock price of Facebook, you know, does go to $75 in 30 days of its lifetime. Well, you could pat your, you know, self on the back. You're right about the direction, but since you were wrong about how far it would go within a specific time frame, you still lose your entire investment. So, you know, based on the newbie option trader mistake, a better goal for every trader would be to select trades based on what provides the most consistent positive returns. And one of the best ways to achieve this is by using option strategies that take advantage of selling options for income generation. But then, you know, how's this done and what's involved in this strategy, and what strategies are there? Well, the first thing, the most important option factor for income generation is time. So time value is what we use in option terms, and it's used for trading strategies that take advantage of accelerated time decay of an option into its expiration. Now, option income strategies are very tied to time value, and the impact that it has on the price of an option. So time value, or extrinsic value of an option, is the premium a rational investor would pay over its current exercise value, which is the intrinsic value, based on its potential to increase in value before expiring. So this probability is always greater than 0. Thus, an option is always worth more than its current exercise value. Now, time value decays exponentially to 0 at expiration. And with the general rule, it will lose about 1/3 of its value during the first half of its life and 2/3 in the second half. So as an option moves closer to expiration, moving its price requires an increasingly large move in the price of the underlying security. So with time decaying, and if you're long an option, you're kind of swimming against the tide or the current. And as you get closer to expiration, that current gets stronger and stronger because of that time decay. So here's a good example of a time curve to illustrate this point. So when you first start out, you're 120 days out or 90 days, you go out on an option, you buy it. The time decay, and we measure this in option terms with theta. And the cool thing too with an options, you have all these free tools that you can use to forecast price and measure price. Even if you're not an option trader, there's some great tools, and they're on these platforms that you can, whatever platform you're using. So the theta decay is very, very slow and slight when you're out 120 to 90 days. Now, as you get further in towards expiration of that contract, when you get to about 30 days out, that's when it really starts to decay. And then when you get to that weekly option, which can be weeklies now, you can do 5 weeks current. You can go from 15 days down to 7 days on these weeklies. It's like time decay on steroids. So you really need to be aware of the element of time when you're trading options. And a lot of option buyers forget that point, or when you're new to options, you don't realize this is a real component that can really damage your trades fast. So step 4 is then how option pricing works. So in order to trade options and understand the various strategies, you need to kind of understand the option pricing and how that works. So really in option pricing, it's made up of time value times the implied volatility times the intrinsic extrinsic value. So once you know these variables, then you're ready to price an option and know what its option premium should be. So the variables again are implied volatility, and this is just basically what the marketplace is implying the volatility of a stock will be in the future based on the price changes in the option. And implied volatility, since it's based on kind of current price of what's happening now, it can also be a benefit to you as well, because when you have like last week, we had that really hard down day. I think it was on Tuesday, and that when you have a really big move down, that really can spike your implied volatility. Now, when the implied volatility goes up, it has an impact on option premiums, and it makes the option premiums go higher. And then what happened the next day on Wednesday, the stock market goes up, option premiums go down. So if you take that in consideration and you were maybe selling some type of strategy with the high premiums, that goes to your benefit. So these little things can really make a big difference in your trading. Now the other thing is then your intrinsic value. Let me erase this. And that's, again, the amount an option is in the money. And then there's the extrinsic value. That's the price of an option less its intrinsic value. So that's the out-of-the-money part of the option. So those are the basic components that are really vital for option pricing. And this is a simple table to kind of illustrate pricing of an option a little bit better and more clearly. So you have your time value, you have your implied volatility, and then you have that intrinsic, extrinsic value there. So times those 3 variables, that equals your premium. Now, on this particular example, this is based on a weekly option. And so what you're seeing here is on Thursday, you get a new option series, and you've got 100% time in there. And then what I did is I kept the intrinsic, extrinsic constant, so you can see how these 2 variables will affect price of the option. So when you have that 100% premium or time in there, and you have implied volatility of 300 times intrinsic, extrinsic set at 1, that gives you your premium of $300. That's what that option's worth. Now, as you go down one day and the price, say it moves sideways, doesn't move at all, that value goes down by 1/8, which is about 12% every day. That option is going to go down on those weeklies. So if the price goes nowhere, you can see here you're losing money. Now, when you come into Monday, half of that life of that option is gone, and even if you jack up the implied volatility, goes high, gets spiked higher, you still hardly go up on that premium because you're losing so much value of that option in the time. So it's a key element for trading options, and one that is overlooked a lot of times. Um, then step 5 is, okay, well, what are the income strategies that are out there that you can choose from, to take advantage of this time decay? And the goal of every trader, in my opinion, should be to select trades based on what provides the most consistent positive returns. And one of the best ways to achieve this is by knowing the income option strategies that are available and then selecting the one that is best for your trading style and trading plan. Now, everybody in this room today, we're all different. We're all going to have different capital accounts. We're all going to have different lifestyles, when we can trade, when we can't trade. So you need to understand what your style is, what you want to achieve, and then you can pick the strategies that best suit your lifestyle and your capital. So what we're going to look at are, the basic income strategies. So there's the covered call, there's the calendar spreads, diagonal spreads, long iron condors, and credit spreads. So we're going to start out with strategy 1, which most of you have probably heard about and maybe you've used, which are covered calls and puts. So for monthly income writing, stock options is the basic component of the strategy. When writing stock options, the premium from the sale is deposited straight into your account, and it goes in, that next business day. So you get to keep that premium regardless of what the stock or option does in the future. Now that's the fun part, when you do set up a trade and you sell an option and you get that premium, it goes right to your bank account and you see it in there. That's the easy part, and I tell my clients and my members, that's the easy part. But the hard part, is keeping that premium, keep it in your bank account, make sure it's there at the end of that life of that option. So stock options times compounding, this can create wealth, and it can create some really great wealth. So from the writing stock options, you can compound into great wealth. For those that understand the power of compounding, that if you took had a 5% gain every month, you can it could make you rich when you compound it. You can see the incredible wealth building power that compounding offers. Now most investors, though, however, overlook the wealth building power of compounding and simply purchase stocks with hopes of its increasing in value. So we've all, again, been ingrained, buy low, sell high, hold, 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 just hold and it'll go up. So while the stock option writers, though, they've increased their returns significantly, the other side of that is that the traditional investors are still waiting and hoping for that big upward stock price movement. And I don't know about you guys, but I imagine a lot of you guys here in the room, and me included, back in 2000, 2007, 8, probably lost a big chunk of capital if we were, invested with, money managers that were just in this buy and hold mentality. So, this is part of, taking your trading into your own hands and being, a little bit more proactive. So by writing stock covered call options monthly, if you did this in a self-directed IRA and you could get 5% gain every month, you could take, in this example, $978 invested, and you could grow that to over $340,000 in 10 years. In contrast, if you just had that same IRA money yielding just 2% interest, it would take you over 100 years to get to that $300 level. So, stock covered call options in an IRA can really provide a way to make up for those years when your retirement funds didn't grow fast enough at all, or even if you lost money. Now, if the market is strong, you want to write covered call options. You want to treat the stock more like a commodity traded just to generate that monthly income, just like if you owned rental property. So you just want to get that rent collected every month, and if the value of your property goes up, that's just an added bonus. So it's not important to want to own the stock the options are written against. It's actually to your advantage. If those stocks are called away, that tells you that you're going to keep that premium. So it's important you like the stock's short-term potential, and you select stocks that are going up, though. That's big importance ingredients of this strategy. But writing stock covered call options, are great source of income when the stock market is going up. But what about the times when the stock market is falling off that cliff, and we're going to, we we get those times. Lately, it's not been as many with the Fed controlling things pretty well, but it'll come. So when the market is weak, you can write, covered put options. Writing stock covered put options allows you to profit from declining stock markets. With stock covered put options, you have already sold that stock short, so you don't really care if it drops sharply at all. So the other option strategies to use in a weak market is to write covered call options on inverse funds or bear market ETFs, and this is the one I prefer to do. So here's a list of, you can Google and get the inverse funds or ETFs, and these are some really good ones to use, like the short QQQ is the PSQ, and then I like the ultra shorts, like the QID, that's a really good one. SDS is a really good one. The Russell TWM. So you can just buy these underlying ETFs and then write calls against those and still do the strategy in a down market. So strategy 2 for income options is the calendar spread. And the calendar spread is a neutral option strategy that profits when the underlying stock remains stagnant or trades within a tight trading range. So when you have a sideways market or one that's just gradually creeping up, this is not a bad strategy to use for income collection. So the counter spreads profit primarily from the difference in the rate of that premium decay between the near-term short option and the long-term options or leaps, which are those long-term options that are a year out or more. Now this is possible because that near-term option premium, remember from those examples, decays faster than the long-term premiums. So here's a graph to show you this example. So basically what you would be doing here is, like, say for example you bought say Facebook or something, and you thought that it was going to maybe go sideways. So you bought Facebook and it was, say, at $60. So you bought this 60 to 90 days out. So you're long that option, but then shorter time closer in, the 30-day or even a weekly, you're short the same strike, a 60, but but a near-term option. So what you're looking here is this premium that you would collect here. Let's say you collected $100, by selling that 60 call, but you're long this call, so you're protected. What you want to have happen is this time decay just to come off, and this premium that you collected at $100, you've got that in your bank account. Well, if Facebook just kind of goes sideways to even up a little bit, and this starts decaying rapidly and goes to zero, you just put $100 in your bank account, plus you still own that $60 call. So it's a really good way for a sideways market, or even in a strategy where you like a certain stock or security, and you think it's going to go up, but it may not go up for a while, or maybe it just creeps up. So this is a way you can kind of inventory a stock, collect income on it, and then once you're out of that short option, let the thing ride up. So it's a really good strategy for that. So that's one that's quite popular to use. Now strategy 3 is the diagonal spreads, and this is a version of the counter call spread as well. In this example, all you do is you purchase an in-the-money leap. So the leaps are the long-term options. They're out a year or 2 years. And so on a diagonal spread, the way I like to do it is you buy a leap that's in the money, and then you sell an at-the-money call or an out-of-the-money call against it, against that leap that you're long. It's just like a covered call. The only difference is, instead of being long shares, you're long an option against it. So this was an example of a trade that I did early in the year, and this was on USO, which is the oil ETF. So at the time, this was back like in January, the USO was trading at $35 a share for that ETF, and so I went out and I bought 10 contracts of the USO, and I went out and I bought the January 2015 calls, the 25 strike, and they were going for around $10. So $10 per option contract. And then at the exact same time, I sold the April 2014 $35 calls against it, and I collected 60 cents. So here's what it looked like, the math of it and how it played out. So sold the 35 April calls, collected $60 per option contract there. So that goes straight in the bank account. And I was long my instead of the shares of USO, I bought those $25 calls, the 2015, and they were going for $10 or $1,000 per option contract. One option contract is equivalent to 100 shares, right? So the debit, you've got $1,000 that you paid out for that $25 call, less your credit you received. So the total exposure on this trade was $940. That's my defined risk. Now, if USO closed below $35 on April expiration, I kept the $60 right there, and my return is 6%, or an annualized return of 72%, just to kind of show the equivalent. Now, the other way you could have done this is just to have sold that credit spread, the $35 calls, still receive that $60, but instead of buying the leaps, you just went ahead and did the traditional trade setup where you bought the ETF and it was going at $35 a share. You bought 100 shares to make it equivalent to one option contract. That would cost you $3,500. So then your return would be that debit out of $3,500, which is your max risk, less the credit you receive, $60, and you would have then had a at risk of $3,440. Now, if it expires below 35, you keep the $60, but this is only a 1.7% return. So you can see the difference here because of the leverage of using the leaps versus the underlying security. Now, in this particular type trade setup, I only do this trade if something's really coming off a bottom. And if you look back on crude on the charts in January, it had really made a nice bottom and was just starting to come up. I don't like this strategy if the market has already hit off the bottom and then maybe consolidates and starts to move up again, because you don't want to be long these leap options if the market decides to correct. So it's a great strategy for kind of a bottoming type trade setup. So strategy 4, and these are my favorite type of credit spreads, and this is the using credit spreads, or called the short vertical spreads or credit spreads. And there are basically 3 within this category. You've got the bear call credit spreads, you've got the bull put credit spread, and then you've got the long iron condor. So the basic construction, they're pretty basic really. So a bear call credit spread, all you're long a call while simultaneously short one call that has a lower strike. So this is what it will look like. So here's your short call. Let's say that's you're short that call at 60. So you're short that, and then as your insurance, you're going to be long a call above it at $65. So you're insured if the market goes above 65. So now let's say you received $100 from selling that 60 call, so that credit goes right in your bank account. This is a $5 spread, 65 minus 60, that's $5, or $500, one option contract. So what this adds up to is that your at risk is $400, and that's your margin. That's all you have to put up. So you can have a small account and do these type trades because all you're putting out is $400. Your potential reward or gain or profit is $100. So it's a pretty good, pretty good deal. That's not a bad return if you can keep that $100 as long as Facebook or whatever this is closes below 60, at its expiration. You keep that $100, and the only capital that you had out there was the margin. Your defined risk is $400, and you make $100. It's a good way to trade because you're collecting premium, and if the market goes sideways to down, you're profitable, and that's a 25% return. And you can do this on a small account. So that's your, looking at what a bear call credit spread, and then the bull put credit spread is just the opposite. if you think the market's going to go up, you want to sell puts. Puts are, the opposite of a call. So if the market's going to go down, you buy puts. If the market's going to go up, you do the reverse and you sell. So in this case, let's say we think Facebook is going to go up, and it's trading at, we'll say it's trading at $50. So we sell a $40, let's say, put, and the insurance is we buy a $35 put below it. So it's the same as the bear call credit spread, just the opposite. So we'll say we collected $100. So we receive that $100 credit for the $40 put that we sold. The spread is $500 wide, so we have that $400 exposure. That's all, at risk. And if it expires above $40 at expiration, we keep that $100 there. And then the other part of it is the long iron condor, which is when you combine these two together. So you have both of these trades or spreads on at the same time. You've got the bear call credit spread on, and you've got the second part of the trade is you've got the bull put credit spread. So that's your long iron condor, and this is perfect if the market goes sideways. So if it, in this example, closed below 60 and closes above 40, you get to keep both the 100 from the short bear call credit spread and the bull put credit spread. So that's a $200 profit. So these are, pretty cool trading strategies for markets to take advantage of that time decay and premium decay. So these are the basic ones that are played out there, and then it's just a question of, okay, when do you get into those type trades, and how do you manage those type trades? And then and that's the big part. How do you keep that premium? So we just covered the long iron condor, but basically it's just that combination of the bull put credit spread and the bear call credit spread. So, and then again, there should be equal distance between each strike price, while the underlying stock pinning strike should be between the two credit spreads or short options. So that's the basic strategy. Now, short vertical spreads or credit spreads, when used correctly, will provide a trader or investor with the greatest probability of success, and are one of the best ways to generate a steady stream of income. And the really good thing about it is it comes down to math and the probabilities of events happening. So what you're seeing here, this is just, in statistics, what they call a normal distribution curve. And, market makers will use what, implied volatility of an option to set an option price and to forecast the expected implied move of a stock up or down by its specific, option expiration time. And now in option terms or statistics, this is also referred to as a one standard deviation move, and it's based on the statistics of the normal distribution or probability of a stock price falling between 2 points, by its expiration. So these are proven, statistical norms that they're theoretical. I mean, they don't happen all the time, but it gives you something to work off of. So in this example, it becomes a very useful tool, for determining price targets, and then you can trade against these targets and use your options to do that. And the other cool thing too is that any option platform that you have will give you all this information. So this, I'm just charted it out for you to see it visually, but in this example, the normal price distribution curve here illustrates that a one standard deviation move on this particular stock that's right here trading at 500 would be between $480 and $520 by its expiration. So this is saying that it's a over 68% probability that this stock will be only trade between 480 and 520, and it's not going to go greater than that by expiration. So this, if you look at it, most options, are going to fall within that one standard deviation range by their option expiration, and this is statistically proven. So 68%, or you're close to 70% of the time, your options will trade between a 1 standard deviation move or what they call the implied move. And we can figure all this out. It's not that difficult. And then the other, 16% of the time it might get above 520, or 16% of the time get below. So if you look at this example, statistically, options, if you buy options, you have, out of the money, like out here or out here, you're going to have about a 60% chance of losing, or even greater. So that's the thing if you can to look at, and it'll really help you. So these are statistics, and everything in trading is about statistics. Now here's one really good example to illustrate this, the difference between using a directional call, buying directional calls, versus selling a bull put credit spread. And then these are both bullish option strategies. So I want to show you the difference between using these two and the benefits that you get. In this particular example, you'll see the big benefit of selling a bull put credit spread, collecting premium, versus being long the option. This is on Wynn Resorts. So this was on May 1st. Wynn was trading at about $207. Strategy 1 was just to do the old typical buy, the at the money $207 call strike. It was going for $11.40, which is $1,140 per option contract. Strategy 2 was a bullish strategy, but it was selling the out-of-the-money bull put credit spread, which was below Wynn's prior low of $189, and which was a 9.5% below its trading price at the time of $207 on May 1st. So what we're going to look at is strategy 1 first. So you're out of pocket $1,140, and you bought the $207 call strikes. Wynn's trading right at that point at $207. So you've got an infinite return if it goes up. Your risk is defined at $1,140, so that's good. Now here's what it looks like on May 1st, right here. It's trading at $207 right there. Wynn blows to the upside, but then trades down hard. And then on May 8th, right here, Wynn is down trading at about $196 right there. So as Wynn comes off hard, and you own this option that you paid $1,140 for it, at this point in time, on the 8th, that option contract now is in the hole $583. Here's the open P&L. So that's what happened on that option contract when it's down there. Now, let's go to May 21st when this thing is recovered. Here's May 21st, and here's that option contract. Now when it's trading at $205, so here we are right here, $205. You'll see that this option contract, though, is still underwater $518. So not good. When that market underlying goes down hard, that particular strategy or option trade got hurt. Now here's the other type of trade. This is a bull put credit spread, which is still a bullish strategy. And on this particular trade, this was on May 1st, right here, same date. Instead of buying directional options, you sold the 187 put down here. You can see how far this is below that low. So you sold that, you collected $513 per option contract, and then as your insurance, you bought the strike $5 below that. You bought the 182 puts. So now you've got a bull put credit spread on, and this is the bull put credit spread. It's the 187, 182 bull put credit spread. Your max at risk, this is your margin you put up, is 370, so you can do it in a small account. Your profit, if it expires above 187 at expiration, is $130. So that would be a 35% return. So that's the bull put credit spread. Now let's see what happens to it as you go through. Now here's the May 8th when the market crashed down here. This particular trade is now, the bull put credit spread is down only $38.50 versus being along that call at $583. You can see your open P&L, you're only down $38.50 versus being down $583. Now here's that bull put credit spread on May the 21st, right here, when the market's recovered. Wynn is at 205, so you're only $2 below where it was originally put on here, now you're in the money, but the long option is still underwater 518. So it's a big benefit there, to credit spreads in this situation, the bull put credit spread, to really benefit you in a sideways to even a down market. So, what we covered here today was how to embrace risk for trading opportunities, avoiding that number one option trading mistake, most important option factor, how option pricing works, and highest probability option strategies, for every market. So, I'm going to get to there are a lot of questions in here. I appreciate you guys holding off, and I'm going to, get to all your questions, but in a few minutes. But I'd also like to, give you a little bit more background about, who I am, and because I know you guys don't know me from Adam, but I wanted to share with you a nice note that I received from one of my clients. So if you take just a few minutes to read this will give you a little bit more idea of, who I am. So I don't want to fire hose you guys too much information, but take a look at that. Really what this points out, this was from Charles, and I was, it's always such a rewarding experience to get any kind of positive feedback from your clients that you're helping them. But one thing you really noticed was that he took my trading course on credit spreads, and it really helped him on defending trades. He was really surprised at how many different defensive measures there were, and I really like the way he used the Swiss Army knife analogy. So I just want to share that with you from one of my clients there. Now, again, my big aha moment was when I incorporated credit spreads. So let's next talk about some simple things to get you started now to generate a more steady stream of income each and every month, and also how you can learn to implement an option income strategy. Does this sound appealing to you guys? And then we're going to get into all the questions you have and go from there. But I wanted to introduce this to you first. So what I'm going to offer here today to you guys is my special credit spread workshop that I did. This was about a month ago, and it was just strictly on income option strategies, and primarily those credit spreads. So this was a course that I did. It turned into a 5-hour course that's all recorded with the PowerPoint, 89-page PowerPoint. So I like the PowerPoints because it's great for note-taking and stuff. So you get the PowerPoints, you get all the recorded modules of this event, and this was 100% on just credit spreads and all that. So if you'd like this, let me put in the copy it in here so you can see it, make it a little bit easier for you. Oh, one second here. Well, oh, okay. Can you put that in there then, Kevin? Thank you very much. Oh, okay, great. Okay, so let me just quickly tell you what's in this course, and then we'll get into your questions. So the other thing too I'm going to do is whenever I take a course or anything that I get into that's new, after you've gone through the material, you always have tons of questions. So what I'm going to also do is for the first 20 that sign up for this course today, and the good thing too is this course is only $97. So if you're not familiar with credit spreads or ever used them, it's a low entry price. And if you've used credit spreads, then this is also going to give you some really good additional information, tips on things that you can do to improve your trading. So for the first 20 that register here today, you're also going to get a Q&A follow-up. Actually, I'll do the first 50 since there's so many people in here. So go to that URL. So what's covered in this course is how to use credit spreads to create low-risk, high-probability trades, how to use credit spreads on stocks and index options such as the SPX or NDX. And this is a great way to collect income each and every month if you understand how to set these spreads on these indexes. How to use non-directional credit spreads and when to use them. How to steadily and consistently grow a small account through credit spreads into a large account. So, you know, in those two little examples, you can do these things on a very low amount of capital, and you've got defined risk. And then the really great part of this course, too, is how to defend these trades. The easy part is putting the trade on, collecting that income. The hard part is, you know, what happens when you get it wrong. So I've got 6 really great defensive strategies in this course. And then how and when to use the iron condors and when not to use the iron condor. There's specific situations for the iron condor and other times when you don't want to have it on. So the other cool thing is you'll learn how to take that 70% probability of winning and convert that to 90% probability with winning just using statistics of the options. And then a step-by-step guide for executing the spreads. And then the best technical analysis I go through using Fibonacci for your support resistance, how to use that. And best market timeframes for your spreads. You know, a lot of you don't want to be sitting at a screen staring all day bug-eyed, so this will show you how to get the spreads set into the day and a lot more. So, you know, again, this course is right there on that link. It's realtraderswebinar.com/power cycle. Put that in. It's only $97. Now, if you don't like the course, if it doesn't work for you, you know, I'll give you your money back as well. So it's a really win-win situation. And then again, the first 50 that sign up here today, you're going to get a follow-up Q&A on this course where you can come in and ask questions. That'll be probably in 2 to 3 weeks, give you time to get through the course. So let's get into some of your questions now. Question here. The credit spread course, I just did a boot camp on income options, and so yeah, this would be pretty much covered there, John. So if you took that, the boot camp went into much more detail about directional parts of the trades. Question, what rules for picking the out-of-the-money short strikes to use? Good question. Let me pull up a chart and I'll show you, you know, what I do. You need to, for these setting these spreads, you need to incorporate support resistance into what you're trading, and then you want to use that to set your short legs. So, okay, so let me pull up a chart and I'll just kind of illustrate that quickly for you. 1 second here. So a lot of times, you know, these trade setups will come down to market direction. And here is, let me get this up here. So for anybody that needs that link, it's down there. So for example, here, let me just pull up, I'll pull up something like, let's see, what do we want to pull up? I'll pull up Google. Google's a really good one for credit spreads because you get a lot of credit. It's got good premium. So let's say, for example, here's Google, here's your daily time frame. So I'll look at a couple different things here. But if you look at Google, one of the obvious things, if you just look at this chart, when Google came down here and started shifting its momentum, what I'll do is I'll use trend lines, and I like to incorporate a shorter term time frame. So I'll use like a 60-minute, and I'll use my daily. So what I'll look at is support resistance. So let's say Google comes down here, which it did on the 17th, and it had a nice pop off the low. So what I'm be looking for is, you know, when Google, say, retraces back to a moving average or something, if I can set a credit spread down here at this support level or below it, preferably, that's where I'll be looking to do it. And then once a stock starts trending like Google and you have a breakout, you know, using trend lines, there are a lot of different ways to do it, and this is also laid out in the course. You know, when it breaks a trend line with momentum, there are a lot of things to look at. I will then set it, instead of, you know, maybe going long the directional options, when it broke that trend line, I'd sell a bull put credit spread down here. I'd look to see what the premium is offered, and I got that momentum going for me. So instead of buying the directional call options with the potential you'll make more money on the directional call options, but what happens if Google then starts consolidating sideways or comes off? So I'll sell a bull put credit spread. I'll do what I call a basket. So I'll buy some directionals, but I'll always do a bull put credit spread in this kind of situation just to offset some of the risk. So you need to incorporate these things in your trading, and I'll also use Fibonacci to give me the support resistance levels, and then I can set my trade levels off of those support resistance by when you get up and you start stalling out. Let's say we get up here, and let's say now Google wants to kind of consolidate sideways. Well, this might set up a good situation to sell a bear call credit spread above, and then let Google consolidate, let the credit decay, and keep that credit. So that's a couple ways to look at that. So let me go back up here and see what else we've got. Oh, thanks, Joseph. Here's a note from one of my clients, actually. He says, "Hi there, Larry. Want to thank you so much for your programs. I've learned lots of new stuff. Thank you very much. Appreciate that." Okay, here's a question. If the price of the stock jumps up too much and you sold the cover call, what would you do? Okay, good question. Now, you've got a couple different things you can do. So, well, first off, though, actually, if the stock jumps up too much and you sold a covered call, that's good. That's good. So let's say we sold a covered call here on Google. Let's say we own the Google at $550 down. Let's say we own Google right here at $560, and we sold the $570 calls against it. So we have that covered call on. We're long the stock here, and we're short that call here. Now, Google spikes up here above that. Well, that's good. So we know we're going to get called out. So what happens? The broker will automatically match the trades together. You don't have to do anything. So you're long the call, you're long the stock at 560, you're short the call at 570. The brokers see that in your account, and they'll automatically exercise that at expiration for you. And if somebody exercises ahead of expiration, all you do is you call your broker and say, "Hey, I want to just use the stock shares that I'm long against that call that got exercised." So it's very simple. You don't have to do anything basically, and that's the good thing about the covered call. When that short strike gets exercised and you're long the stock below it, that's all you have to do. So let's go back here again. Yeah, so that URL is realtraderswebinar.com/powercycle, and the first 50 that sign up will get that 2-hour not 2-hour, but the Q&A that will be a follow-up. That is correct. Let me go back through some more questions. Question: what is the newbie option trader mistake? Okay, well, the big mistake is that what happens is if you're just buying directional options outright, and let's just try to find another example here. Just looking at charts. Google's been on a tear on the upside, but let's say here, you see that Google's going up, and it's a nice and strong pattern. And when it gets here, at 582 this was back early in the week, let's say you bought, you thought, wow, it's going to keep going, so you buy weekly options right here at 582, and then you can see the next few days it just gets crushed. So you would have lost money on those directional options. Now, here, this is not a really good place to be setting a trade for a number of reasons, but let's say if you did do that long trade, instead of buying those directional options here, let's say you sold a bull put credit spread down here and collected premium, you would have still made money on that move up. So it looks like I'm about out of time, but I really appreciate everybody being here today, and I hope this was fruitful for you to give you some ideas of other ways that you can trade to make a more consistent type of equity return to your accounts, even trading or investing. So it's something that you should incorporate with whatever you're doing, is to learn some of these income option trades. And this is a great course for you guys to start. And if it doesn't work for you, it's a win-win, because it's only $97. You can see if it works for you. I go into a lot of standard deviations, all that implied volatility, how to project those, forecast those returns. If it doesn't work for you, I'll also give you your 97 back. So that being said, thank you so much for being here today, and thanks, Kevin and Traders Reserve.
Thank you so much, Larry. And again, everyone, that was Larry Gaines of Power Cycle Trading. If you want to check out Larry's offer, you can go over to realtraderswebinar.com/powercycle.